everyone, and welcome back to the Deep Dive. I hope you are having a fantastic week and are geared up to confront one of the most intriguing investment paradoxes I think we've seen in a while, certainly in the small cap universe. Today, we are turning our analytical lenses toward a company that is, quite frankly, an absolute classic in the Indian consumer durable sector. It's a name that's just synonymous with trust and quality for generations. Hawkins Cookers Ltd. When you talk about core household staples, especially, the essential safety items like pressure cookers and robust cookware, this company, well, it really defines the premium benchmark. And we're not talking about a mega cap giant here. This is a very focused business with a market capitalization hovering right around $490 million.
Which is roughly 4,138 crore for our listeners in India.
Exactly. But you really shouldn't let that small cap status fool you. This business boasts genuinely elite financial metrics. And that brings us to the central question, the promise we're making to you today. This is, for all intents and purposes, a fortress business. It has a powerful, durable brand moat, and its returns on capital employed. Its ROCE consistently clock in at approximately 45%.
Which is just world-class. That's top tier.
Absolutely. It's compounding machine territory. So if the quality is so high, why are we even doing this deep dive? Because this exceptionally efficient engine is only managing, sluggish revenue growth. It's averaging around a 5% compound annual growth rate over the last few years. Yet the market is pricing it at a premium PE ratio of 36.5 times. So the question is, are investors simply paying way too much for the comfort of safety? Is this, in fact, the textbook definition of a quality trap where fantastic historical performance blinds investors to the limitations of future growth?
Yeah.
That is the core conflict we are here to unpack in meticulous detail.
That is the ultimate test of investor discipline, isn't it?
Yeah.
It's a massive question. It forces us to confront that core tenet of value investing. That quality, no matter how high, does not justify an infinite price.
That's right.
If you buy the best business in the world at the worst possible price, you are still going to lose money. We've seen this pattern play out so many times, where the safety and the security of these predictable cash flows get conflated with the return potential of the stock itself.
Right.
The excitement about an elite ROCE often overshadows the cold, hard math of, very limited growth.
Which then brings up the next question.
How do you translate this kind of detailed analysis into action, into actual capital deployment? And for that, you absolutely need the right tools.
Absolutely. For those of you who want to act on these investing ideas, whether it's in the small cap Indian market or anywhere else, having a professional grade platform that can handle global markets, complex instruments, and provide high-level analytical tools is, it's non-negotiable. We really believe in having the right toolkit for serious investing. We've partnered with Interactive Brokers, a platform we trust implicitly, to offer our listeners a stock bonus when you sign up using our dedicated link.
So you get a bonus that helps kickstart your portfolio with a professional-grade platform, and you support the independent, detailed research we do here on the channel at the same time. That link with all the specific details on the sign-up bonus is right there in the description below the episode player.
That's right. And of course, if you are finding value in this kind of in-depth, meticulous discussion, the single best way to let us know and to ensure you get notified the minute we drop the next deep dive is to subscribe and like this video. It truly helps us bring this research to you. And if you have any questions or, further thoughts regarding this whole Hawkins Cookers paradox, please manifest yourself in the comment section. We genuinely read those comments and integrate them into future discussions.
Perfect. So, with the housekeeping squared away, let's start talking about the price for a moment and start talking about the engine itself.
Great idea.
We have to establish the foundational strength of this business first. So let's jump into pillar number one, the fortress, the business engine, and the economic moat.
Will do. Regardless of the current price, we first have to understand why this company is fundamentally considered so elite. And we can start with the unit economics, which are fascinatingly simple and durable. They manufacture pressure cookers and cookware tavas, frying pans, things like that. It's a non-flashy, essential consumer goods business. So let's drill down on the unit economics and its pricing power. The core transaction is a simple one-off sale. You buy a pressure cooker, and it lasts 10, 15, maybe even 20 years. It's not a subscription model.
Right.
But critically, that initial sale sets up a highly valuable, long-tail replacement cycle.
And this is a detail that often gets overlooked, but it's absolutely critical for that recurring, high-margin revenue. Think about the consumables that must be replaced for safety and function. The rubbered gaskets, the safety valves, the little whistle weights.
Yeah, parts that wear out.
Exactly. They wear out regularly. They're inexpensive, but they mandatory. And crucially, consumers overwhelmingly return to the original brand for that guaranteed fit and safety.
It's almost like a razor and blade model, isn't it? Except the razor is a piece of durable steel cookware, and the blades are these safety-critical rubber parts.
A perfect analogy.
These replacement sales are high margin, they're repetitive, and they constantly feed back into the system, reinforcing that brand loyalty. You add to that the predictable, low volatility demand driver of continuous new household formation across India, and you have a revenue stream that is extremely predictable.
But the real evidence of market dominance, the ultimate test of quality, lies in its pricing power, especially when you look at the cost structure. I mean, this company is, by its very nature, a manufacturer of physical goods.
Right.
So if you look under the hood at their costs, raw materials, primarily aluminum and steel, account for a huge chunk of their cost of goods sold. It's clocking in at around 56%.
That is a massive exposure to commodity price volatility.
Huge. Normally, a manufacturer exposed to such dramatic swings would see their gross margins become incredibly erratic. They could potentially collapse during periods of high inflation or, steel price spikes.
But that's not what the data shows at all, is it?
Not even close. This is the finding that really separates Hawkins from its peers. Despite substantial raw material volatility over the past 5 years, and we've seen some extreme commodity cycles in that time, the gross margins have remained resilient and unbelievably stable.
They're consistently resting at approximately 50%.
That stability is not an accident. It is the evidence of true, unadulterated inflation pass-through.
And that's the definition of a strong brand, right? It means they can raise prices commensurate with or even ahead of their input cost increases without seeing consumers abandon the brand en masse and switch to a cheaper alternative.
Precisely. The volume doesn't collapse, the margin holds firm.
The margin stability proves the moat exists. It's an empirical, quantifiable measure of their pricing power. They are selling a premium product, and the market accepts that premium even when the premium increases.
Okay, so let's unpack that moat itself. It's not a patent moat or a network effect moat in the tech sense.
No, it's a deep psychological moat.
Exactly. The primary moat here is intangible: branding and safety trust. To frame this using some slightly academic but highly useful mental models, we are discussing effective valence and uncertainty reduction.
Don't worry about the big words, let's break them down. Effective valence simply means the emotional feeling attached to the brand, that deep, positive familiarity.
And uncertainty reduction is the consumer's desire to pay extra to guarantee nothing goes wrong.
And this is so critical because of the core product itself. A pressure cooker is not a toaster.
No.
It's a pressurized vessel. It is, at its heart, a potential bomb in your kitchen if the materials, design, or safety mechanisms fail. The consequence of failure isn't inconvenience, it's potential injury or even worse.
So imagine you are the head of a household. You're standing in a store in small town. You have a choice.
Yeah.
The trusted, generations-old, slightly more expensive Hawkins cooker, or a cheaper, unorganized competitor offering a 30% discount.
You are not just comparing features like color or handle shape here. You're comparing the risk of injury to your family.
You're paying for that peace of mind premium.
Yes. This high cognitive and emotional cost of failure is what allows Hawkins to command a price significantly higher than the myriad of unorganized, smaller competitors that flood the market, often offering products with lower safety standards.
The rational consumer defaults to the trusted brand, regardless of a small price difference, because the stakes are just so high.
Then you layer on the secondary moat, which is distribution, or what we sometimes call the power of scale.
And especially in a geographically vast and diverse market like India, a strong, vast, and entrenched dealer network provides a critical physical availability advantage.
Think about the barrier to entry here. A new entrant doesn't just need a good product.
Right.
They need thousands of physical touchpoints, relationships with dealers built over decades, credit lines, and the ability to service that physical supply chain efficiently. A customer walks into a smaller city hardware store, and Hawkins is there. Top of shelf, reliable.
New entrants cannot replicate that ubiquity quickly. It takes decades of patient relationship building and consistent quality delivery.
We must, however, do the anti-moat check. What is threatening this stability?
Always have to kick the tires.
The slow-moving threat is technological shift. Specifically, the move towards smart cooking, like electric pressure cookers, and the widespread adoption of induction cooktops. If the market rapidly shifted away from traditional stovetop cooking, their core product would be jeopardized.
But what's highly insightful here is management's measured response.
It is. They haven't chased every flashy electric gadget trend. Instead, they've adapted their traditional product line with induction-compatible bottoms, ensuring their core product remains relevant and functional in modern kitchens.
So it's not disruptive innovation.
No, it's stabilizing defensive adaptation, which perfectly suits a moat of safety and trust.
And this leads us directly to the concept of soft power and culture. We spend so much time analyzing the financial numbers, but the operational culture is what dictates those margins and that quality.
It is. This is an old-school, disciplined, and intensely process-oriented corporate culture. They're not trying to move fast and break things.
They're trying to move deliberately and not break anything.
Exactly. And that culture translates directly into what we call process power, a fanaticism about quality control.
We know they're almost fanatical about their internal testing, sometimes referred to as Power 7, ensuring every cooker meets rigorous standards well above the necessary regulatory minimums.
When your product is inherently tied to physical safety, you need a near-zero defect rate. And this obsession with precision is hard for competitors to clone. It directly reinforces that primary safety mode.
But here is where we must introduce the necessary challenge. Is that rigid, disciplined culture a flaw? Does it lack the agility needed for rapid, startup-style innovation? We often celebrate disruption, but for this specific business, I would argue the rigid culture is actually a feature, not a bug.
That's a crucial distinction.
If their maximum achievable growth rate is already constrained to, say, 5 to 8% due to market maturity, why on earth would they need to introduce the chaos and risk that accompanies startup-style innovation?
They wouldn't. It would be counterproductive.
The rigid culture ensures that the current 50% gross margin remains stable, the 45% ROCE remains high, and the quality reputation is never, ever compromised. It prioritizes stability and safety over market disruption.
Which is precisely what the premium segment consumer is paying for.
Absolutely. The final piece of this moat puzzle is how all these elements, the safety trust, the vast distribution, and the quality culture, converge into what Charlie Munger would call the Lallapaloosa effect.
It's a powerful, multi-factor behavioral loop working in the company's favor.
There are 3 cognitive biases that are just intertwined and at play here, making the consumer choice almost automatic.
Okay, let's break them down.
First, you have social proof. This is generational.
Right.
You have decades of mothers, grandmothers, and now young households relying on this specific brand. The internal narrative is, my family has used this safely for 3 generations, so I should use it. It is validated by decades of tradition and shared experience.
It creates an automatic preference that transcends simple marketing. And the second one is availability bias. Thanks to that ubiquitous, decade-spanning dealer network, the brand is always top of mind and physically present when the consumer walks into a store. The path of least resistance is choosing the brand that is physically available and instantly recognizable, especially when buying something so critical.
And the third, and probably the strongest one, which reinforces the primary moat: fear and risk avoidance.
Yeah.
When the stakes involve kitchen safety and potential injury, consumers avoid the risks associated with cheaper, unknown alternatives, even if the immediate savings are substantial.
The marginal utility of saving a few hundred rupees is zero compared to the risk of an explosion.
The result of this confluence of biases, social proof, availability, and fear avoidance, is a dominant position in the premium segment that no amount of advertising spend from a new entrant could effectively achieve in the short term.
It's a self-reinforcing loop of trust and quality, making the moat incredibly deep.
So Pillar 1 confirms our initial premise.
Yeah.
We are analyzing a genuinely high-quality fortress business with durable economics.
Okay, so now we move to Pillar 2, which examines how efficiently this machine operates and, critically, how management handles the substantial cash generated. We're talking financial discipline and capital allocation.
Let's start with the quality of earnings test, looking at the margins trajectory. We already established the resilience of gross margins at 50%, which protects the top line.
Right.
Now we look at the bottom line, operational efficiency. Operating margins, or OPM, have been remarkably stable, consistently resting in the tight range of 13 to 15% over the last 5 years.
And what's important for growth investors to understand is the key finding here. There is no sign of what we call margin leverage.
Right, where margins expand significantly faster than sales due to scale or something.
Exactly. The stability in that 13 to 15% range strongly suggests the business has reached a plateau of operational efficiency.
Which is a double-edged sword, isn't it? It's positive for quality because it means management is running the business as lean and well-managed as possible. The earnings are predictable, but it's a significant headwind for future growth. Investors cannot rely on margin expansion to artificially inflate future EPS growth beyond the underlying revenue growth. What you see today is largely what you get tomorrow, operationally speaking.
And let's contrast this stability with the behavior of many modern compounders. We need to do the stock-based compensation, the SBC reality check.
This is a massive distinction. Unlike so many high-growth modern tech companies that generate impressive revenue growth but systematically dilute their shareholders with large stock option grants, or SBC.
Which effectively lowers the cash earnings available to public shareholders.
This company operates very differently. It is promoter-led and SBC is negligible.
Critically, the share count is stable. With promoters holding around 56% of the company, it confirms that reported EPS growth is truly real.
It's deriving from actual operational success and revenue increases, not from financial engineering or massive dilution that siphons value from public shareholders.
When they report a profit, that profit actually belongs to the shareholders, undiluted.
And this stability allows us to appreciate the true power of their operation, elite capital efficiency.
We highlighted the number earlier, but we really have to internalize the magnitude of this. The return on capital employed, or ROCE, averages a staggering 40 to 45%.
Let's put that into perspective for a second. Most good businesses, the ones we would consider worthy of a deep dive, are trying to clear a 15% hurdle rate.
A 45% ROCE means this company generates 3 times the profit for every dollar deployed compared to an already good peer. It's an incredibly efficient machine, requiring minimal working capital and low maintenance capex to maintain high profitability.
This is the ultimate quantitative quality signal.
However, this very efficiency creates a structural problem, which we call the saturation point.
Because the ROCE is so high and the management is so disciplined, the business simply cannot find enough opportunities to reinvest large sums of capital at those elite rates.
Right. If they could, they would be growing at 30% a year, because every dollar put back in would turn into $1.45 almost instantly.
But they can't. They've saturated the current market opportunities that guarantee a 45% return, and that leads to the inevitable high cash pile and the slow revenue growth we see.
Which brings us directly to capital allocation strategy, the CEO's report card. What does management do with all that cash they can't efficiently reinvest?
When a business generates substantially more cash than it can efficiently reinvest, management has to make disciplined choices about deployment. And we can outline their cash deployment hierarchy very clearly.
First up, reinvestment. It's limited, as much due to opportunity saturation as it is to discipline. They are not suddenly going to open hundreds of new factories or launch into entirely new high-risk categories just to burn cash.
Right, they prioritize sustaining that 45% ROCE.
Then second, you have dividends. This is the primary reliable release valve for excess capital. The company consistently maintains a high dividend payout ratio, usually between 50 and 60% of profits.
This provides a tangible, predictable, and substantial return to shareholders. It effectively turns the company into a stable yield vehicle.
Third, buybacks. These are largely absent.
Management shows a clear preference for robust, consistent dividends over opportunistic buybacks. And while some sophisticated shareholders might prefer buybacks for tax efficiency, the dividend preference offers superior transparency and consistency for the broader, retail-heavy Indian investor base.
They are committed to returning cash flow reliably. They treat the dividend almost like a fixed contract.
And finally, let's conduct the fragility test, because quality means resilience.
In this volatile, debt-laden world, this company's balance sheet is so clean it squeaks. They are a beacon of financial resilience.
The company is virtually debt-free, evidenced by a minuscule debt-to-equity ratio of 0.06.
This confirms an almost zero fragility profile. This company is going nowhere. It will survive any recession, any commodity spike, and any credit crunch.
So, to summarize the first 2 pillars, we've confirmed a fortress of quality, durable economics, elite capital efficiency, and zero financial fragility.
Right. And if you were judging this solely as a private business, a perpetual cash cow, you might argue it's worth any price.
But it's a publicly traded security, subject to growth expectations, and that forces us to confront Pillar 3, the growth ceiling.
This is where the mathematical tension between valuation and future cash flows becomes acute. We have to reiterate the underlying performance. Revenue growth is sluggish, with the 3-year CRR of only about 5.2%.
For a company of this maturity, selling physical essential goods in a highly penetrated market, the base rate of future growth is likely limited to tracking nominal GDP growth, at best. It's moved beyond the hypergrowth phase and into the mature utility phase.
And the total addressable market, the TAM reality, supports this constraint. The Indian pressure cooker market is already highly penetrated. Nearly every household that needs a pressure cooker, and importantly, has the purchasing power to afford a premium brand, already owns one.
Or maybe even two, given the replacement cycle.
Exactly. We are not talking about exponential market expansion here.
So management isn't sitting still, but the avenues for growth are fundamentally limited. We see two primary drivers. First, premiumization.
This involves shifting existing users from their standard low-margin aluminum products to the higher-margin hard anodized or stainless steel product lines.
That provides a revenue lift and, crucially, a modest margin lift. But it's an incremental shift. It's not a sudden catalyst.
No, the transition takes time. It depends on consumer willingness to upgrade, and it's still constrained by the overall number of households. We can expect this to add a few percentage points of revenue lift, but it won't magically make this a 20% growth company.
Then second, you have exports. Currently, this is a small driver, representing only about 6.7% of total revenue.
It is a potential avenue for geographical expansion, but we have to ask the critical question. Why hasn't export growth taken off already, given the company's 70-plus years of operation and world-class quality?
The answer is complex, but it typically relates to brand awareness and adaptation costs. They are a premium domestic brand.
Competing internationally means facing different safety standards, established domestic competitors in target markets, and massive marketing costs to build trust from scratch.
It will likely remain a modest driver. It might add 1 to 2% to the overall growth rate, but not enough to change the fundamental 5% domestic growth trajectory.
So we're talking about incremental growth, likely topping out between 4% and 9% in a really good year.
And this severely limited growth outlook is what clashes so violently with the current valuation. This brings us to the centerpiece of the paradox, the implied market expectations.
And we can dissect this using the logic of a reverse discounted cash flow or a reverse DCF.
The market's wager right now is profound. By pricing this company at approximately 36 times trailing 12-month PE, the market is effectively valuing Hawkins not as a mature consumer durable manufacturer,
but as a high-growth compounder that sustains hyper-efficient, rapid expansion.
Let's translate that 36x PE into cold, hard financial reality for you. That PE ratio translates directly to an earnings yield of only about 2.7%.
Think of the earnings yield as the immediate return you get for every dollar you invest. You're essentially buying a bond that only yields 2.7% immediately.
And this is the dramatic disconnect we have to confront. We are operating in an environment where the risk-free rate in India, the rate you can get from safe, guaranteed government bonds with zero risk of capital loss, is sitting comfortably around 7%.
I mean, if you walked into a financial institution and presented a business plan for a stable, low-growth consumer company that offers a guaranteed initial return of 2.7%, while the government is offering 7% risk-free,
They would politely but firmly laugh you out the door.
they would. The market is effectively telling us this business is less risky than a government bond and capable of heroic growth simultaneously. That is mathematically questionable.
So to justify paying 36 times earnings in this high-risk free rate environment, the company wouldn't just need to grow at 5%. Our models show it would need to compound earnings at a rate of 15% or more annually for at least a decade.
Just to meet a standard, reasonable, required rate of return.
And the current growth rates we observe, which realistically fall in that 4 to 9% range, fall dramatically short of this implied 15+% expectation.
There is a fundamental quantitative contradiction between the price being paid and the expected future performance of the underlying cash flows.
This points toward our primary hypothesis. The valuation likely reflects a potent safety premium.
I think so, too. Investors are desperate for a high-quality, debt-free, liquid small cap in a market full of volatility and governance risks.
They're willing to accept a mathematically suboptimal current earnings yield, that 2.7%, simply for the peace of mind that the company won't fail and the earnings won't disappear.
They are paying an enormous premium for certainty, not for growth potential.
And that safety premium is quantifiable. But the investor must ask if that premium is justified when the alternative is a guaranteed 7% return elsewhere.
Which brings us to Pillar 4. We need to put a number on this conflict. We need to triangulate the intrinsic value using different methodologies to establish a fair price range and, crucially, the necessary margin of safety.
We can't rely just on one anchor. So method A is historical mean reversion.
Okay.
This is the argument that the market has historically understood the value of this quality, and thus we should reference what the market usually pays for this specific asset. The 5-year median PE for Hawkins is remarkably stable, sitting around 32 times earnings.
So if we take the consensus forward EPS estimate for the next fiscal year, which sits around 230 per share, and we apply that historical median PE of 32x,
The implied fair price comes out to approximately 7,360 TAC. This is one anchor point, based purely on the historical willingness of the market to pay for this premium quality.
okay, then we move to method B, the owner earnings or value investor view. This methodology intentionally ignores past market sentiment and focuses strictly on the discounted value of future cash flows. It forces discipline.
For this calculation, we have to use inputs that align with the reality of a mature business. We use a conservative but realistic growth rate of 8%, assuming some success in premiumization and modest exports.
And we apply a realistic discount rate that reflects the opportunity cost of capital for a stock investor. Let's use 10%.
Applying this fundamental cash flow analysis suggests that a more realistic long-term multiple for an 8% growth, 45% ROCE business, given today's cost of capital, is around 25 times earnings.
Which is still a significant premium multiple, but it's anchored in reality.
Applying that realistic 25x multiple to the estimated EPS of 230 gives us an implied fair price of about 5,750.
And that tells a very different story from the historical market median. It is saying, based on the physics of future cash flow expectations, the intrinsic price should be substantially lower.
So what does this triangulation give us? We have a high anchor point at 7,360 based on historical market sentiment.
And a disciplined, cash flow-based low anchor point at 5,750.
This allows us to define the buy zone.
We believe the price range that provides a necessary margin of safety and allows for a reasonable return given the low growth environment is somewhere between 5,800 and 6,500.
This range acknowledges the quality while respecting the financial gravity of that growth ceiling.
And the current status. The stock is trading significantly above this triangulated fair value. It's sitting approximately 20% above our upper bound.
This solidifies our central thesis. It is an expensive stock, even factoring in the quality premium.
Let's consolidate this into our final scorecard summary. The quality score is absolutely, undeniably high GH.
No question. We're talking elite, 45% ROCE, a durable, psychologically fortified brand, and zero financial fragility. If you're looking for safety, this is it.
However, the valuation score is definitively expensive. The stock is currently priced for high-growth compounder status, demanding 15+% growth, while the underlying business is realistically delivering consistent, high-quality performance in the 5 to 8% range.
That's the disconnect.
So to finish the analysis, let's summarize the two sides of the investment thesis.
The bull case highlights are compelling, focusing entirely on capital preservation and defensive compounding. First, it is a highly defensive compounder. That 45% ROCE ensures that the business is protected against inflation and economic downturns because it needs so little capital to function.
Okay, that's fair.
Second, the ongoing premiumization shift, the move to stainless steel and hard anodized products, provides a small, consistent, high-margin tailwind that should help earnings track the higher end of that 5 to 8% range.
And third, the consistent high dividend payout, which is 50 to 60% of profits, acts effectively as a reliable bond proxy for yield seekers in a low-growth environment. This return is tangible and predictable, unlike speculative growth stocks.
But the bear case provides the critical counterpoint, focusing on capital return risk. First and foremost is the fundamental growth wall. A long-term CAGR of 5 to 8% simply cannot support a 36x PE multiple indefinitely. Gravity will eventually assert itself.
Right. And second, despite the proven pricing power, there is still material exposure to raw material risk. If aluminum or steel prices spike rapidly, it could compress margins temporarily if the price hike execution lags even slightly.
It's a temporary risk, but a real one.
And finally, the largest risk of all, the valuation trap.
While this company is undeniably high quality, purchasing it at this elevated price does not guarantee a high return. The risk is less about business failure and more about severe capital impairment due to multiple compression.
Okay, so we've established the quality, but now we have to put on the red team hat and present the harsh mathematical reality to you, the listener, in quantitative terms. This is the crucial takeaway.
When you decide to buy this stock at 36 times earnings today, you are effectively buying a long-duration asset that is currently yielding 2.7%. That's the mathematical inverse of the 26 PE ratio.
And you are doing this while expecting a realistic coupon growth of about 5 to 8%.
Let's put that number next to the opportunity cost. Compare that 2.7% current yield to the risk-free rate we mentioned, 7%.
You are deploying capital at a 2.7% yield when you can get a guaranteed 7% from the government plus modest inflation protection.
It is, by definition, mathematically suboptimal capital deployment for anyone seeking standard, market-beating returns. The high quality is only serving to suppress your entry yield dramatically.
It illustrates the point perfectly.
Yeah.
The powerful deep moat is protecting a castle that simply isn't expanding much. It's a secure, steady revenue stream, but the investor is drastically overpaying for that security.
And this leads directly to the most critical risk for the investor: capital impairment risk via PE compression. This is how high-quality companies destroy long-term returns.
Explain that.
If over the next 5 years the market acknowledges that 5 to 8% growth doesn't deserve a 36x multiple, and the multiple reverts merely to its historical rational cash flow mean of 25x, which is still a premium price, by the way, the investor faces a severe capital impairment. Even if the underlying business performs perfectly, hitting its 5 to 8% growth targets, that multiple contraction from 36x to 25x implies a loss of around 30% of your capital.
So the valuation contraction, not business failure, becomes the dominant driver of your negative return over the next half-decade.
Precisely. So we leave you with this final provocative thought to consider and explore on your own as you navigate your portfolio decisions. What exact premium is truly justified for absolute safety and elite 45% ROCE?
If the ultimate goal is superior total capital returns over the next decade, would you rather own this highly efficient 45% ROCE business at a massive 36x PE, where your growth is fixed at 5% and you face severe multiple compression risk?
Or would you rather search for a merely good 25% ROCE business that is priced rationally at a 15x PE, which gives you a higher entry yield and a much smaller risk of valuation reversal?
Which approach truly maximizes long-term compounding when the growth rate is the limiting factor?
The answer forces a confrontation between the emotional joy of quality and the cold discipline of price.
A brilliant distinction and a perfect way to end the analysis, separating the quality of the business from the quality of the stock. Thank you so much for completing this deep dive with us today. We hope this meticulous analysis gives you the clarity needed to navigate the paradoxes of paying up for safety in the market. Be sure to subscribe for the next deep dive, and we'll see you very soon.